Now, I know a lot of y'all have already been trading for some time, and you've certainly experienced a moment like this where you have an A plus setup, everything lines up perfectly, the structure's really clean, the location makes sense, your key level is obvious, everything checks off in your trading plan. You even wait patiently for your level to get hit. And when it does, you execute with confidence, and everything at first looks really good. But price turns around and runs straight through your stop loss. You go back over the trade, check over what went wrong. You see that the entry model was valid, the break of structure confirmed, the retest was really clean. You maybe even had an additional confirmation from an indicator, and yet you still took that loss. So, what actually happened? Because if the model was correct, the level was valid, the structure confirmed, why did the trade still fail? So, here's the part most traders never fully internalize. The setup was not necessarily your problem. The pattern or level wasn't either. And most importantly, you're not a bad trader because you run into this. The problem is that you're making decisions based on information that only show outcomes. Candlesticks only show you where price opened and closed. Market structure shows you good swing points, shifts in trend. SMC define high probability locations and levels. All of these tools are extremely useful. They all help you define where a decision might matter, but they all share the same exact limitations. They show you what already happened. They do not show you the interaction that caused it. So every move in the market is the result of buyers and sellers colliding at a price. One side applies pressure, the other side absorbs it or fails to absorb it. Someone becomes trapped, someone gains control, liquidity is consumed, removed, positions are forced out. All of these things were interactions. And price moves because of these interactions. A candlestick compresses that entire negotiation into a single bar. So when you're looking at a bullish engulfing candle and a break structure and you're seeing that strong close above the previous high, that's great. But what you do not see is whether aggressive buyers are actually stepping in with commitment or whether sellers are quietly pulling their liquidity or whether the move was fueled by real participation or forced liquidations. Or maybe that level you trusted was absorbing pressure the entire time. So you're making an assumption about intent without being able to observe it. And sometimes that assumption is correct, but it's still incomplete. And over time, incomplete information is going to create long standing frustrations. And I see tons of people going through the cycle for years before they find order flow. And it leads to traders to tweak all of their strategies or move to other ones that aren't actually broken. You start to system hop, you start to over optimize everything, look for new confirmations because you feel like something is missing or something can be better. But what you're missing is the interaction. You're missing the actual auction and the actual understanding. And order flow exists to close that gap. So order flow isn't some new strategy. It's not a predictive model, and it's definitely not ever going to print some kind of buy or sell signal that you can base your decisions on. And it doesn't replace market structure. It doesn't replace SMC. Order flow is just the real-time study of how buyers and sellers are interacting while the candle is still forming. So it allows you to observe who's acting aggressively, who's providing liquidity, where effort is being applied, and does that effort actually produce a result, or who is being trapped in the process of all this. So in simple terms, candlesticks show you the result of that negotiation, where order flow shows you the negotiation itself. So if you trade smart money concepts, supply demand, or ICT, Wyckoff, or any form of structural analysis, none of that becomes obsolete here. In fact, those frameworks are extremely effective at defining context and locations. They tell you where to pay attention to. They tell you where a decision could matter. But what they do not show you is what actually happens when price reaches that level or location. That is where order flow becomes critical. So think of your current framework as the map. It shows terrain, structure, high probability zones. Order flow is the x-ray, and it reveals what is happening beneath the surface when price arrives at these zones. So The map without the X-ray will leave you guessing at the moment of contact. And the X-ray without the map lacks direction. So together, these create clarity from chaos. And this is why I do not trade SMC or order flow in isolation. I trade structural context confirmed by observable interaction. That distinction separates hoping a level will hold from seeing whether it actually is being defended. So if you've ever taken a breakout that failed really quickly, or you took a trade off an order block and it didn't react the way you thought, then you've already felt the cost of trading outcomes instead of causes. When you learn to observe interaction directly, your decisions begin to change. Your confirmations, they carry much more weight because they're based on participation, not a shape or not some kind of entry model. You recognize when effort is real and when it's being forced, and you begin to see actual liquidity and if it's granting permission or whether it's denying permission. And you learn when to engage, when to reduce risk, and just as importantly, when to stand aside and stay out of the trade. So this course it's obviously not a bunch of signals or shortcuts or going to be handing you new entry models to copy. It's about teaching you how markets actually function at the auction level and then teaching you how to read that data that reflects that function. So we begin with the foundations first. So in module 1, we're going to break down market mechanics and auction principles. You have to understand why price moves in the first place. From there, we move into the platforms. We're going to teach you how to use Bookmap and Market Monkey and read all of the tools that they provide. And we're going to focus deeply on what each metric truly represents. And only after that foundation is built, we're going to move into execution, trade management, risk logic, and integrating a full, complete system. Now, this is professional grade software and it's professional grade data. So you have to use this carefully and wisely. You have to truly understand how it all works because it can amplify mistakes just as easily it can sharpen your edge. So it's still going to require patience, discipline, and the willingness to rebuild how you interpret the data on the screen. But if you're tired of feeling like something is missing, and you want to stop assuming intent and start observing actual interaction, and you really want to understand what's actually happening at your level instead of hoping, then you're in the right place. Because before you can trade interaction, you have to understand the mechanics that create it. Before you can read pressure, you have to understand what pressure actually is. And before you can execute with confidence, you definitely have to understand why price moves in the first place. So that's where we're going to begin. So in the next module, we start at the only place that makes sense: market mechanics and auction foundations. That is where real clarity begins.